Welcome to this lecture on how monetary policy shapes inflation and jobs. Over the next few minutes, we'll walk through the key channels policymakers use, the trade-offs they face, and why the same interest rate move can have very different effects depending on inflation, wage setting, and labor market structure. I'll highlight who typically bears the cost and how that matters for policy choices. The Phillips curve describes a historical inverse relationship between unemployment and inflation, suggesting lower unemployment tends to coincide with higher inflation and vice versa. But this slide also poses a question. If policymakers deliberately change rates, does that trade-off still hold in the same way? We'll explore how expectations, wage setting, and price adjustment speed can alter that classic link. When interest rates rise unexpectedly, borrowing costs climb, which weakens both consumer spending and business investment. That drop in demand reduces aggregate demand, raising unemployment in the short run and slowing future wage and price growth. The key point is that surprise tightening transmits quickly through borrowing channels and produces a near-term rise in joblessness before any cooling of inflation. Monetary tightening doesn't hit everyone evenly. Firms typically freeze hiring first and then cut headcount, producing disproportionate unemployment spikes among lower skill and minority workers. That uneven pain means vulnerable groups face larger income shocks even as aggregate inflation cools. So it's important to recognize the distributional consequences when judging the costs of policy. As joblessness rises, workers' bargaining power falls, and nominal wage growth slows, which in turn pulls down expected inflation. Over several quarters, this mechanism lowers future price inflation and can validate the original rate increase. In short, higher unemployment feeds back into weaker wage and price dynamics, which is how tightening eventually helps reduce inflation. Monetary tightening hits firms through softer wage bills and weaker demand, compressing profit margins and producing staggered price setting across the economy. With firms adjusting prices at different times, aggregate price growth decelerates, but the overall response is smaller and slower when baseline inflation is already very low, making policy transmission less potent in that case. When trend inflation is near zero, wage and price contracts adjust less frequently, so the same rate hike tends to produce a larger rise in unemployment, but only a smaller fall in inflation. That dynamic flattens the Phillips curve and erodes central bank leverage, meaning policymakers may cause more labor market pain for less inflation payoff in low inflation environments. In a high and volatile inflation environment, firms and workers reset prices and wages rapidly, so demand shifts translate quickly into price changes. That faster price resetting makes reducing inflation less costly in terms of unemployment, restoring a more favorable trade-off and giving policymakers a stronger lever to lower inflation with smaller employment consequences. Tightening cycles raise job losses disproportionately among younger, less educated, and Black workers, resulting in much larger income volatility for vulnerable groups compared with high-income households. The chart emphasizes this unequal impact and suggests that preventing excess slack should be considered a distributional imperative, since income risk for vulnerable workers rises significantly during hikes. Accommodative policy benefits differ across households. Looser monetary policy can stabilize employment and lower income risk for poorer households, while generating wider price dispersion and raising real income volatility for wealthier ones. The optimal policy challenge is to balance these asymmetric welfare effects, protecting vulnerable households from income shocks, while managing volatility for richer segments. Central bank credibility and clear forward guidance amplify policy effectiveness by shaping public beliefs and expectations. When the public trusts consistent action and transparent guidance, the Phillips multiplier effect weakens, meaning lower required unemployment costs to reduce inflation and better anchored long-run expectations, which makes disinflation less painful. In low inflation eras, policymakers often rely on forward guidance, asset purchases, and fiscal coordination to boost demand without big rate hikes, whereas in high inflation eras, conventional tightening exploits a steeper Phillips curve while trying to protect vulnerable workers. The takeaway is that the appropriate toolkit depends heavily on the inflation regime, and the need to shield the most affected households.